Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world by looking at their actual reports. And let's just say this next one is quite an interesting read because it seems our top insurers are having a bit of a rough time with their investments, but things aren't all bad in their underwriting business. Before we dive in, if you love these kinds of reports where we cut through the corporate jargon and get straight to the numbers, make sure you hit that subscribe button. And if you want to chat with other analysts about these filings or just get a heads up on what we're covering next, join our Discord community. The link is in the description below. Alright, let's start by looking at where Greenlight Capital Ray stood financially at the end of June 2025. Compared to the end of last year, their total assets grew a bit from about 2 billion to over 2.1 billion, which sounds good, but let's see what's inside. Their biggest asset is this investment in a related party fund called Solasglas, and it's growing from 387 million to over $461 million. That's a chunky piece of their business, and as we'll see later, it's showing some serious volatility. On the other side of the balance sheet, their liabilities also went up, mainly because their reserves for future claims called loss and loss adjustment expense reserves increased from 860 million to $944 million. This isn't necessarily bad, it just means they're setting aside more money for potential payouts, which is normal for an insurance company. Now let's see how they performed in the second quarter and the first half of the year compared to last year. Good news first, their gross premiums written, meaning the total amount of insurance premiums they've taken increased by about 6% in the second quarter and by about 11% for the half year. This indicates they're writing more business, and their net premiums earned, which is the actual revenue recognized from those premiums, also saw a nice jump by over 3 million for the half year. That's a solid performance on the underwriting side. But here's where things get interesting. That investment in Solasglas that we talked about earlier took a big hit. In the second quarter alone, it cost them over $18 million compared to an income of over $4 million in the same period last year. And for the half year, it went from a positive 22 million to a negative 13 million. This investment is clearly a major factor impacting their overall profitability. Despite that investment loss, their actual underwriting business itself performed much better. Their net underwriting income for the second quarter shot up from just $333,000 to over $8 million. This shows their core insurance operations are getting stronger. And importantly, they had no catastrophe losses in the second quarter this year, compared to almost $8 million in losses from big weather events last year. This absence of major unexpected payouts really helped their underwriting results. However, they did see some adverse development, meaning they had to increase reserves for past claims by about 3 million this year. Compared to favorable development last year, this suggests that claims from previous years are turning out to be more expensive than initially thought. And all this combined led to a much better combined ratio, meaning how much it cost them to underwrite business and pay claims, which improved from almost 100% to around 95% for the quarter. That's a significant operational improvement, and for the half year, it also improved from about 99% to 95.9%. So even with that massive investment loss in Solasglas, their net income for the second quarter only dropped from about 8 million to a miss. Throws the underlying strength of their underwriting business ability to absorb investment swings. This translated to diluted earnings per share of just 1 cent for the quarter, down from 23 cents last year, and 87 cents for the half year, down from $1.01 last year. But what about their book value per share, which is a key metric for insurers? The good news is it increased by over 5% from the start of the year, reaching $18.97 by the end of June. This suggests that despite the investment volatility, the company's intrinsic value is growing. Now let's zoom into their two main business areas, the open market and innovations. In their open market segment, which is their larger business, they saw a solid increase in gross premiums written both for the quarter and the half year. This growth was primarily in their multi-line and specialty lines, but net premiums earned here actually decreased by about 15% for the quarter and 11% for the half year. This is a bit of a mixed signal, indicating that business mix and how premiums are recognized over time are playing a role. Their loss ratio, the amount paid out in claims compared to premiums earned, also saw an increase. Here the attritional loss ratio, meaning losses from normal claims rather than big events went up driven by their casualty business, which is facing inflation pressures. On the flip side, their acquisition cost ratio, meaning the cost of selling insurance policies, improved because of better business mix and lower costs on financial and multi-line business. This cost control is a positive sign. Overall, the combined ratio for this segment improved significantly to around 92% from nearly 95% last year, which is excellent news for their core underwriting operations. Now for the innovation segment, which focuses on startups and new ventures. Gross premiums written here were up slightly for the quarter, but down slightly for the half year. This segment is smaller and seems to be growing at a slower pace. Net premiums decreased quite a bit more here by over 15% for the quarter and over 11% for the half year. This indicates a change in the types of business they're writing, or perhaps a more conservative approach. The loss ratio in this segment is notably higher, and it worsened significantly for both the quarter and the half year. This is largely due to a substantial increase in prior year reserve development, meaning claims from past years are costing more than expected, particularly in their financial lines. Their acquisition costs here also went up, both for the recent quarter and the first half of the year. This is mainly because of new business that comes with higher selling costs and some regulatory adjustments. Consequently, the combined ratio for innovations is much higher, over 100% for both the quarter and the half year. This segment is currently operating at a loss, which is a concern. And to top it off, this segment also has that volatile Solasglas investment contributing to its losses, making the overall picture for innovations quite challenging right now. On the investment front, the company is very open about the performance of Solasglas, and they break down the returns. The long portfolio, which bets on prices going up, had a loss of 0.2% for the first half of the year after a small gain last year. And the short portfolio, betting on prices going down, actually had a gain of 1.7% in the first half of last year compared to a loss of 4.2% this year. Their macro bets on broader economic trends were positive, but not enough to offset the other movements. This resulted in a net loss for Solasglas of 40% in the second quarter and a net gain of 2.9% for the first half of the year. This is pretty significant volatility, and it heavily impacted Greenlight Capital's overall results. The company also highlighted that their prior year adverse loss development, which is essentially having to pay more for old claims, has increased notably. This is a common theme in the insurance industry, where inflation and legal changes can make past estimates inaccurate, and it's a drag on profitability. Looking at their balance sheet, their debt to equity ratio is quite low at just under 9%. This is very strong, meaning they rely on their own capital more than borrowed money, giving them a lot of financial flexibility. So what's the overall story here? Greenlight Capital Re's core underwriting business is showing real strength with improved combined ratios and higher premiums written. The investment side, however, is a different story thanks to that Solasglas fund, which experienced quite a downturn this quarter. The company is in good financial shape with low debt, but their investment performance is a major wildcard. The company's direction seems solid on the underwriting front, showing resilience and growth even in a competitive market. The innovation segment, however, is struggling and needs some serious attention, but the big story is that investment in Solasglas, its performance, directly impacts Greenlight Capital's bottom line, and investors will be watching it very closely. What are your thoughts on this filing? Do you think the underwriting strength can overcome the investment losses, or is Solasglas a ticking time bomb? Let me know in the comments below, and if you found this breakdown helpful, give this video a thumbs up and subscribe for more. I'll see you all in the next one.